is causing a market sell-off this week, with trading halted twice, currency devalued, and weak economic data concerning investors around the world. My guest today says there were 4 key events this week, but not all were important for investors. We'll look at what you need to know with Michael Craig, Vice President and Director at TD Asset Management. So welcome, Michael.
Hi, thank you for having me.
The big news today, circuit breakers. What happened?
So overnight, the Chinese market opened and was open for about 30 minutes. The circuit breakers were tripped, and it fell after closed quite quickly and fell about 7%. So this is on top of a beginning of the year loss of about 8%. And now year to date, the Chinese market is down about 15%. So pretty tough start to the year for the Chinese stock market.
Exactly, and then I guess it sounds like next they're going to remove those circuit breakers.
Yeah, so the original circuit breakers, I mean, we're still talking about a fairly nascent market. It's not really that mature.
Yeah.
The circuit breakers were set up such that they really reduced liquidity in the marketplace, and as a result, it hasn't really taken a lot of volume to really push down prices, and so as a result, they've removed those circuit breakers today, and we'll see how things open up tonight as far as how the market responds to that.
Yeah, it'll be good to watch. Now, one of the other, was that important? Let's start off with that.
Yeah, so I think in the big picture, 6 months from now, this will be just a kind of a wrinkle in the history of the Chinese stock market. It's not really that important long term. It really hurts if you're invested there in the near term, but nothing's fundamentally changed about the valuation of Chinese stocks or what's changed in the Chinese economy. And those are the bigger issues that we look at as far as how we feel about China and how it affects the rest of our assets that we manage for our clients.
Now, what about the currency? They were also
Yeah, so the
there.
currency is a much more important issue. This week it has come off somewhat, but it's important to note that, first of all, the Chinese currency for many years was very much, not quite as it was a soft peg. And over the years, because of the strength of the US dollar, it has grown very strong, and that's really hurt the Chinese export industry. They've started to move to more of a basket approach, which includes euros and yen. And as a result, the Chinese currency has weakened, and we expect it to weaken modestly over the next year. The risk is that if we see a sharp devaluation in the Chinese currency, that this is a really bad indicator of the health of the Chinese economy. And it also points to the fact that the rebalancing process that needs to start to take hold in China from to have kind of solid supportive growth in the future is being inhibited. And so for us, one of the key elements is to see that currency perhaps gradually weaken, but not in a rapid fashion.
What about the economic data that came out this week?
The economic data has been quite weak for a while. The PMI, or the Purchasing Managers Indices, have been quite poor. The manufacturing industry in China has been quite weak for a while now. You want to see a shift or transition in that economy to more of a service-based element, and that's not really happening. And so whenever time you have a rebalancing process, there's winners and losers. The winners of China's previous expansion since the early 2000s was the kind of the heavy industries. There's a lot of investment-driven growth, and you saw a rapid growth in China. As they transition to a more of a consumption-based model, they will have to accept a much lower rate of growth going forward. And that really has profound effects on the global economy. Many countries that were set up to supply China's investment boom now are really facing strong headwinds, Canada being one, but certainly Australia, Brazil, New Zealand, Indonesia. All those commodity-producing countries have really felt it quite ruthlessly as China's growth model is changing.
And what about the end of the large shareholder kind of trading limits?
So that was another kind of, again, in a kind of an immature market, sometimes you see policy put forth that's really a reaction to what's happening. In the summertime, when the Chinese market really sold off, the authorities forced major shareholders to buy large stakes in the market and forced them to hold them above a certain level. Now, the problem when you do that is you create a theoretical ceiling to a market. Everyone knows that at a certain level, those people are going to be able to sell, and that in many ways doesn't allow the market to actually rally past that level. And so you put almost a theoretical ceiling to the value of share prices in China. So that was the first mistake. The second is once people realized that this was being lifted, it again added to more stress in the marketplace. Now they've changed that today. They're only, it's becoming much more challenging now for those people to actually sell. They've got to give 12 days written notice. Can only do 1% at a time.
Wow.
And so again, the rules are changing quite fluidly, if you will. Again, this is really hurting and really adding to a lot of volatility in the near term. But again, this isn't going to have a huge impact on the economy of China going forward. The key elements are the pace of that currency decline, whether the Chinese authorities can rein in credit growth, which is very, very important, as well as centralized power in Beijing, and start taking some of that power that's away from more of the state and local governments. And that's kind of the key, on a big macro sense, the key things that need to occur over the next year for China to be able to engineer a healthier growth profile.
Yeah. So is that really why the global markets seem to be also reacting so significantly?
So it's key. The key thing is that the global economy is $77 trillion. China makes up, the U.S. makes up about 17 trillion, and China makes up about 10. So China is a huge player in the global marketplace, and so we have to pay attention, obviously, because it's such a key. Such a key economy, and so that is the real takeaway for investors: is that China is big, it matters, and these events that happen in China are going to add to a lot more near-term volatility in the markets. The way we look at it is we've been tenderly holding more cash, and in this volatility, what you get is a repricing. You get the same asset today at a much lower price, and it does provide us some opportunities to add assets for our clients at much more attractive levels.
Thank you very much, Michael. I've been joined by Michael Craig, Vice President and Director at TD Asset Management. I'm MaryAnn. Thanks for watching.